Before you look at the next oil headline, look at Japan. That sounds wrong at first because this crisis appears to belong to the Persian Gulf, missiles, tankers, choke points, shipping lanes, crude. That is the visible part. That is the part television understands. But I think the next decisive pressure point may sit thousands of miles away in a country that did not start this conflict, cannot control it, and may still end up being the one forced to move first, Japan. This is the deeper structure that matters. The market keeps telling itself a familiar story. Gulf instability drives oil. Higher oil hurts consumers. Maybe inflation ticks up. Maybe growth slows. That is all true, but it is still too shallow because this crisis is not only putting pressure on commodities, it is putting pressure on the countries that import stability itself. And Japan is one of the purest examples of that problem anywhere in the world. Start with the obvious piece. Japan imports almost all of its fuel. That alone makes it highly exposed to any serious Gulf shock. But exposure is not the same as vulnerability. Vulnerability is what happens when you take an energy importing country and then trap it inside a weak currency, a massive debt burden, and a political system with very limited room for clean policy choices. That is where Japan is now. And that is why I think the real question is not whether oil matters. It is whether Japan becomes the first major ally that is forced to transmit Middle East stress directly into the American financial system. Let me explain what I mean. When a Gulf conflict intensifies, imported energy gets more expensive. That is painful for everyone, but it is especially painful for an economy that needs foreign fuel for basic functioning. Then the second layer hits, investors run towards safety and the dollar strengthens. That hits the yen. Once the yen weakens hard enough, the energy bill does not simply rise with crude. It rises again through the exchange rate. Suddenly, the same barrel of oil becomes dramatically more expensive in local terms, not because the world price changed again, but because Japan is paying for it with a weaker currency. That is how you get a compression cycle. Energy squeezes the trade position. The stronger dollar squeezes the currency. The weaker currency squeezes household purchasing power. The weakening domestic picture squeezes policymakers. And once policymakers are squeezed badly enough, they start looking for a lever big enough to matter. Japan owns about $1.2 trillion in US Treasuries. That pile matters because it sits at the intersection of two systems. For Japan, it is part of the national balance sheet and part of the external defense mechanism. For the United States, it is part of the global demand base that helps keep its borrowing structure functioning smoothly. As long as the world feels stable, those two realities coexist without much tension. Once stress rises, the same asset begins to mean different things to different capitals. Washington sees stability. Tokyo may begin to see optionality. And when the biggest foreign holder of US debt starts needing optionality, every yield-sensitive market on Earth has a reason to pay attention. Now, I need to be careful here because loose language makes bad analysis. I'm not saying Japan is guaranteed to unload treasuries in some dramatic one. The act governments do not usually move like hedge funds, and serious pressure does not always end in the most theatrical outcome. But that is not the correct threshold anyway. The real threshold is much lower. What matters is the point at which investors start to believe Japan may have fewer passive choices available than before. That belief alone can move the market because the treasury market right now is not a calm market waiting for new information in a rational mood. It is already carrying heavy issuance, inflation sensitivity, fiscal anxiety, and political uncertainty. It is already asking whether future demand will be as reliable as the old model assumed. So if a Gulf shock starts pushing Japan toward visible defensive behavior, that does not land in a vacuum. It lands in a market already primed to interpret stress as regime change. This is why I think Japan is the real pivot in this story. Iran can threaten the Gulf can threaten global energy pricing, but Japan can threaten the assumption that America's financing environment remains insulated from allied distress. That assumption has been one of the quiet foundations of the entire post-crisis investment world. We built portfolios as if American yields were affected mostly by American variables, with foreign stress arriving as a secondary echo. But what if foreign stress reaches the treasury market not through panic alone, but through the portfolio decisions of the very allies meant to stabilize the system? That is a different order of risk. And there is one more layer that makes this worse. Japan is not cornered by one problem. It is cornered by overlapping ones. It cannot casually raise rates because the debt burden makes that route dangerous. It cannot casually ignore the yen if the yen enters a more disorderly phase because imported inflation becomes politically toxic. It cannot casually absorb prolonged energy stress because households and businesses eventually start carrying the damage in ways governments cannot hide. Every normal policy answer comes with a built-in cost. That is what makes the situation dangerous. Not one dramatic weakness, but a narrowing corridor of acceptable moves. I call this the ally stress transfer. A regional war does not break the American financial system directly. It pressures an ally. The ally has limited room. The ally starts defending itself with the tools it actually has. And one of those tools is an asset. The United States depends on being quietly held. That is how a Gulf War becomes a treasury story without ever needing to pass through a formal act of hostility toward the United States. This is also why the water angle in the Gulf matters more than most people think. If the crisis is only about oil, markets still imagine inventories, substitutions, temporary relief, and managed pain. If the crisis starts to look like a threat to desalination, civilian continuity, and social stability, the timeline compresses, political reactions become faster, risk pricing becomes harsher. Every exposed country starts acting with less patience. That shorter fuse matters enormously for Japan because its room to wait is already limited. In other words, the more the Gulf story shifts from commodity disruption to system disruption, the more likely Japan is forced from careful discomfort into active defense. And active defense is where the Treasury question becomes unavoidable. Now, step back and look at what kind of story this really is. It is not primarily about whether one more tanker gets through. It is not primarily about whether oil opens $5 higher. It is not even primarily about whether inflation prints a little hotter next month. It is about whether the global dollar system can absorb a geopolitical shock without asking one of its most important allied holders to start protecting itself first. That is the level where this becomes dangerous. Because if Japan is forced to act in a more visible way, the message to markets will be brutal. The message will be that the old shock absorbers are no longer passive. The guardians of stability are now part of the instability. That is when borrowing costs can move faster than officials are comfortable with. That is when equity markets start repricing not just earnings, but the cost of capital itself. That is when recession risk stops being a theory and starts appearing inside financing conditions. And that is why I would watch Japan before I watch the next dramatic Gulf clip. The Gulf may provide the spark, but Japan may be the first place where the system shows you it cannot absorb that spark cleanly anymore. Watch the yen, watch energy pass through. Watch anything that suggests Tokyo is losing patience with passive defense. And above all, watch its yields. Because if yields begin climbing in a way that no longer looks like a normal inflation scare, you may be watching the moment this crisis escapes the region and enters the structure of global finance itself. That is the real story here. Not that oil is rising, not even that the Gulf is unstable, but that America's own ally may become the mechanism that transfers this war into the price of money.